In the boardrooms of Wall Street and the gilded halls of global finance, a wave of visionary Jewish entrepreneurs quietly reshaped the rules of wealth and power. From immigrant financiers who built empires out of nothing to modern-day titans steering trillions of dollars, their stories are woven into the very fabric of corporate America. Through drama, triumph, betrayal, and innovation, next-generation leaders carry forward a legacy forged in adversity. This audiobook peels back the curtain on their journeys, revealing the bold risks, ingenious strategies, and unbreakable resilience that turned outsiders into architects of modern finance. Chapter 1. The Money Changers of the Ghetto. You step off the crowded Lower East Side tenement streets and into a cramped back room where a handful of men huddle around a wooden table covered with dusty ledgers. It's the early 1900s, and most people around you are scraping together pennies to buy bread. Yet here, in this unglamorous storefront, Abe Strauss is quietly rewriting the rules of commerce. He didn't inherit a silver spoon. He arrived as an immigrant with nothing but his wits and an unshakable belief that small bets, made smartly, can compound into fortunes. Abe began by trading commodities you've never heard of: buckwheat, cottonseed, and pig iron. His first big win came when he noticed a sudden drought in the Midwest would drive up wheat prices. Unlike flashy ticker-tape brokers, Abe called local farmers, listened to their worries, and bought just enough contracts to turn a tidy profit. His secret? He focused on one crop at a time, learning every nuance: how rain forecasts affected yields, how rail delays rippled through markets, and which elevators charged the lowest storage fees. By zeroing in on a single niche, he sidestepped Wall Street's noise and built a reputation for reliable insight. Here's the first rule Abe lived by: master your niche before you expand. You're not going to conquer every market at once. Pick one corner, learn it inside and out, and let your credibility grow organically. But Abe wasn't a lone wolf. He understood people who felt excluded by the polished brokers of Manhattan's financial district, people like him. Over bowls of tea and loaves of dark rye, he formed informal alliances with fellow Jewish immigrants. They shared shipping schedules, pooled small sums for larger trades, and protected each other from scams. This tight-knit network became his competitive edge. When rumor of a rail strike surfaced, he heard it first through a fellow emigre at the docks, giving him precious hours to adjust his positions. That brings us to Rule 2. Build a trusted circle before you need it. Start by connecting with peers who share your challenges. Share information freely, and it will return multiplied in opportunity. But the real test came when an entire shipment of cottonseed collapsed in price overnight. Panic set in across the brokerages. Most traders dumped their positions and locked their doors. Abe stayed calm. He knew his cost basis, the price he'd paid, was lower than the panic price, so he quietly added more to his holdings. He treated his gut feeling like a compass. If you've done the homework and your numbers still work, you don't panic. 2 weeks later, prices rebounded, and Abe's earnings doubled his typical monthly profit. Translated into today's terms, that means Rule 3. Trust your research, not the crowd's fear. When everyone's yelling sell, revisit your own data. If your thesis holds, consider doubling down instead of folding. As you listen, imagine Abe's backroom glowing under a single kerosene lamp while he scribbles margin estimates in the ledger's margins. He didn't have fancy software, just meticulous notes and the discipline to walk away when a deal didn't fit his criteria. That's Rule 4. Know when to walk away. If a trade or project doesn't meet your risk-reward ratio, don't force it. Your time and capital are precious. Preserve them for opportunities that fit your playbook. Let's pause for a short case study. In 1912, the Titanic disaster disrupted shipping lanes for months, sending grain prices into a roller coaster. Abe's peers panicked and liquidated, but Abe spotted an overlooked detail. The insurance payouts for sunken freighters inflated capital reserves in maritime companies. He bought select shipping stocks at a discount. Within 6 months, those shares climbed back, and then some, rewarding him with yields most brokers only dreamed of. From this you learn, Rule 5. Look for hidden ripples after a crisis. Catastrophes create blind spots in the market. If you can identify how one event indirectly strengthens another sector, you find profit where others see only risk. By the end of the chapter, you recognize that Abe Strauss wasn't some mythical giant on Wall Street. He was an everyman who refused to be boxed in by prejudice, who leaned into his community's strength, and who treated every trade like a puzzle demanding respect for the details. He taught us that fortune favors preparation, not gamblers, and that the greatest edge sometimes comes from collaboration more than competition. As you move on to the next chapter, ask yourself, what niche could you master if you applied Abe's playbook today? Which small network could turn your next big idea into reality? And when the next panic hits, will you be ready to trust your numbers instead of your nerves? The answers lie in the simple but profound rules Abe Strauss used to turn a ghetto storefront into the cradle of corporate America's first money changers. Chapter 2. Bond Kings and Wall Street's Ascent. Imagine you're sitting in a cramped city hall meeting in 1950s Newark. The mayor nervously flips through budget pages while local contractors glare, waiting for payment. There's a problem. The city needs cash to repave streets and build schools, but tax revenue is slow and banks won't lend without strict collateral. Enter Mike Harris, a sharp-dressed young financier with a knack for seeing opportunity in municipal chaos. He didn't just sell bonds. He rewrote the rulebook, and today his playbook still works. Here's what I learned on those hardwood floors. The narrator would begin, voice low and steady. When a town is desperate, you don't lecture them on finance. You help them solve a real problem. Mike's first rule, find the underserved issuer. He spent his mornings scanning newspapers for towns running deficits or hammering mayors with repair requests. If you want to break in, start by reading your local paper's municipal section. Identify 3 towns struggling with pensions, schools, or water treatment. That's your hunting ground. Next came relationship building, not cold calls. Mike would show up unannounced at town offices, not in a suit and tie, but in a comfortable cardigan, something that said, "I'm here to help, not judge." He'd sit down with clerks and bond counsel, ask about the roof leak in the library, and listen more than talk. Actionable tip: find a small concession, offering to cover printing costs for their bond prospectus or donate a few hours to help answer investor questions, and you earn goodwill that banks and big firms can't buy. Once he had the town's ear, Mike turned to investors. He knew Wall Street loved volume, but they hated risk, especially political risk. So he packaged his municipal bonds into simple categories: waterworks, school refurbs, library upgrades. No banker jargon. Promise one clear project per bond. Investors could pick exactly what they wanted to back. Actionable rule: when you're pitching any deal, break it down to a single project or outcome. Complexity kills interest. Clarity sparks action. But clarity alone wasn't enough. Mike introduced the idea of step-up coupons. Instead of paying a flat interest rate, his bond started at 2% for the first 2 years, then climbed to 4, then 6, matching the town's ramping construction schedule. Early adopters locked in lower rates, and long-term holders benefited as projects proved successful and risk diminished. It was a win-win that felt daring without being reckless. Insider tip: structure your deals so early investors feel rewarded for faith and later investors feel secure because they can see tangible progress. Let's pause for a quick case study. In 1962, Paterson, New Jersey, needed $5 million to rebuild its aging water mains. Banks balked. Local contractors threatened to walk. Mike swooped in. He arranged a bond sale with 3 staggered interest tiers tied to water pressure tests. After month 1, the town delivered improved flow. After month 2, contractors reported reduced leaks. Investors who bought into the 3rd tier saw a 6% return on money they put in when the system was already running smoother. That success story became a poster child on Wall Street. Moral: tie your financial incentives to measurable outcomes. Of course, you'll hit snags. Pain point: city councils delay approval. Mike's trick was one-on-one prep. He'd invite each council member for coffee, explain the bond terms in plain English. No fancy slides, and leave behind a 2-page cheat sheet they could read at home. That aggressive transparency eased fears and turned skeptics into advocates. Rule of thumb: whenever you face bureaucratic gridlock, break down your pitch into bite-sized, jargon-free memos tailored to each decision-maker. By the late 1970s, Mike Harris had cornered the municipal market. He wasn't just selling debt. He was reshaping how deals were done. Towns no longer saw bonds as burdens, but as tools, and investors stopped viewing municipalities as risky. Today, the municipal bond market tops $4 trillion. Millions of small investors rely on Mike's early playbook without realizing it. For modern listeners, here's your play-by-play. Scan for need. Check local news sources weekly for funding shortfalls. Invest in relationships. Offer value first. Print costs, meeting space, expert contacts. Simplify your offer. One project per deal, one clear price. Structure incentives. Use staggered rates tied to milestones. Communicate relentlessly. Jargon kills. Plain language wins. Chapter 3. The Merchant Bankers Who Redefined Corporate Credit. You're listening to the story of Helen Goldman Sachs, a composite of the bold visionaries who transformed how companies borrow money. Imagine a factory owner in 1950s Detroit who needs cash to buy new machinery. Traditional banks say no. They're risk-averse, sticking to old rules. Enter the merchant banker. Helen and her peers didn't just underwrite loans. They built relationships, structured deals, and created new credit products tailored to each company's needs. Helen's first rule: know your client's business inside out. She spent days on factory floors, asking about production cycles, raw material costs, and seasonal sales swings. Rule 1 in practice: before drafting a term sheet, list the top 3 drivers of your client's cash flow. If you can't, you're guessing, and that's a red flag. Next, she pioneered relationship finance. Instead of a one-off loan, she offered a revolving credit line. Think of it as a corporate credit card. Companies could draw funds when they needed them and repay when cash flowed back in. Tip 2. Set up a credit facility with a clear draw and repay schedule. It means you're not paying interest on money you don't use, and your lender sees you manage cash responsibly. Then came the breakthrough: custom covenants. Helen knew blanket restrictions, like assets must exceed liabilities, weren't enough. She added simple, specific metrics: maintain inventory turnover above X days, or keep receivables below Y% of sales. These became early precursors to modern covenant packages. Actionable Rule 3. When negotiating terms, propose at least 2 covenants tied to real-time operational metrics: sales growth, inventory age, even employee turnover, so both you and your lender track the same health indicators. Here's a short case study. In 1972, a mid-sized textile manufacturer needed $5 million to expand. Banks balked at its uneven cash flows. Helen dug into monthly sales reports and saw a pattern. Revenue spiked every spring and autumn. She structured a loan that allowed draws in January and June, with repayments in April and September, right after peak sales. The factory got the money when it truly needed it, and the bank got repaid when cash was flowing. By year 2, defaults were 0. Lesson: align financing with real cash cycle rhythms. Helen's 4th tip: diversify funding sources. She didn't rely solely on her own firm's balance sheet. She syndicate D loans, inviting other merchant banks and even insurance companies to participate. This spread risk and let her client access larger pools of capital. Practical step: if your project needs more than one lender can comfortably provide, draft a simple syndication outline. Identify 3 potential partners, share basic deal terms, and build trust before you finalize the main loan agreement. By the 1980s, Helen and her peers had created innovative credit instruments: term loans, revolving lines, mezzanine debt, convertible notes. They packaged these into a customized capital stack for each client. Actionable Rule 5. Think of financing as layers. Secure senior debt first, lowest interest but strictest covenants. Then add mezzanine tranches, higher cost, fewer restrictions, but don't over-leverage. A balanced stack protects your upside without burying you in debt. Finally, Helen focused on transparency and communication. She held quarterly calls with key executives, reviewed financials line by line, and flagged potential covenant breaches before they happened. Her mantra, "A problem foreseen is a problem half solved." Actionable tip 6. Set up a monthly dashboard for your lender. Include 5 key ratios: cash burn, gross margin, debt service coverage, days sales outstanding, and current ratio. If any metric drifts, address it in writing within 48 hours. By breaking old molds, combining deep operational insight, creative deal structuring, and rigorous communication, Helen Goldman Sachs and her contemporaries rewrote the rulebook on corporate credit. They showed that lending isn't just about money. It's about partnership, flexibility, and foresight. And if there's one lesson for today's entrepreneurs, don't treat financing as a one-time transaction. Treat it as an ongoing relationship, structured around clear metrics and mutual trust, and you'll unlock capital on terms that let your business thrive. Chapter 4. Taking on Wall Street's Old Guard. Imagine walking into a boardroom packed with suits who've been calling the shots for decades. Their power feels absolute, until someone like Carl Icahn shows up and turns the entire game upside down. Icahn didn't inherit a seat at the table. He barged through the door, grabbed the microphone, and demanded to be heard. That's the first lesson in shaking up any industry. Don't wait for permission. When Icahn spots a company trading below its true value, he buys a significant stake, enough to make executives sweat. Here's the simple rule: own enough to matter. You don't need a majority. You just need a big enough piece that management can't ignore you. If you hold 5 to 10% of shares in a mid-sized firm, suddenly every board decision affects your wallet. That creates immediate leverage. Next, Icahn studies the company's weaknesses. Is cash sitting idle on the balance sheet? Are divisions underperforming? He hunts for hidden value like a prospector panning for gold. To do the same, start with the numbers. Open the annual report, flip to the cash flow statement, and circle any buildup of cash or underused assets. If you find millions gathering dust, you've found your entry point. This approach isn't for bean counters alone. Anyone can download financials online and spot obvious gaps. Once he's in, Carl launches a dual attack: research and public pressure. First, dig into every footnote, press release, and SEC filing. Find inconsistencies or underexplained figures. Then, write a crisp, public letter to the CEO. It might begin, "Dear Ms. Thompson, as a significant shareholder, I urge you to consider the following changes," and end with a clear demand: sell a division, spin off an asset, or return excess cash as dividends. Rule 3. Make your ask impossible to ignore. A well-timed letter, published on a major newswire, turns a private negotiation into a boardroom spectacle. Public pressure is more than theatrics. It forces transparency. Executives hate bad headlines, especially when investors start whispering about a takeover. So Icahn times his announcements carefully. He often unveils his stake just before earnings calls or annual meetings, maximizing media coverage. To replicate this, time your moves around key events. If you're pushing for change in your own company, maybe you manage a department, align your proposal with quarterly reviews or budget planning sessions. It gives your idea a spotlight and a deadline. But calling out problems isn't enough. You need a clear, actionable plan. When Icahn takes on a transport company, he doesn't just say you're undervalued. He proposes selling off the real estate arm, cutting costs in underperforming routes, and offering shareholders a special dividend. Rule 4. Always pair criticism with solutions. Your credibility and your chance of success hinges on your ability to map out the what next. In 1985, Carl Icahn targeted TWA, a once proud airline struggling under debt. By acquiring 13% of its shares, he forced management to negotiate. He publicly suggested that splitting the airline's real estate holdings into a separate company could unlock massive value. Faced with the prospect of a boardroom coup, TWA's directors agreed to his plan, ultimately selling their property assets and returning cash to shareholders. That case study shows how a focused blueprint wins battles faster than vague demands. Not every fight ends in victory. Sometimes boards dig in their heels or launch poison pills to block activists. When that happens, Icon has another trick up his sleeve: escalation. He'll buy more shares, recruit other large investors, or even propose alternative board candidates. In real terms, if your proposal is stalled in committee, escalate it the next day. Send a follow-up memo, enlist a respected colleague to back you, or request a meeting with the CEO's boss. The key is persistence without aggression. You're not there to burn bridges, but to build consensus from the top down. Throughout these battles, Carl's style remains direct and unfiltered. He avoids jargon, speaking in plain English. This company is sitting on a pile of cash it's not using, he might say on live television. That clarity resonates with everyday shareholders and makes it harder for executives to deflect criticism. If you're pitching change in your organization, adopt the same tactic: ditch the buzzwords. Instead of saying, "We need a paradigm shift in capital allocation," say, "We have $2 million we're not investing. Let's put it to work or give it back." Finally, remember the human element. Even the toughest executives are people with reputations to protect. After his battle with Time Warner in the early 2000s, Icon took pains to frame his criticism as a shared goal: stronger stock performance. By positioning himself not as an enemy, but as a partner with skin in the game, he opened doors that slammed shut for less tactful activists. So Rule 6. Frame your intervention as a win-win. Highlight how your suggestions benefit the company, its employees, and its customers, not just your own portfolio. At the end of the day, taking on an old guard means challenging entrenched power with conviction, preparation, and clarity. Own enough to be heard. Do the homework. Publicize your case at the right moment. Offer real solutions. Escalate tactfully. Speak plainly. And always position your victory as a shared triumph. Follow these rules, and you'll find that even the most imposing boardrooms have cracks waiting to be pried open. Chapter 5. The Private Equity Revolution. Here's the deal. Private equity isn't some shadowy backroom game. It's a repeatable playbook for buying, improving, and selling companies, often with borrowed money. I'm going to walk you through the core steps Leon Black and his team at Apollo mastered, and give you 4 concrete rules you can use, whether you're eyeing your first side hustle buyout or simply want to think more like an investor. First, find a target with hidden value. Apollo didn't swoop in on Fortune 500 giants. They hunted cash-strapped firms with strong core assets. Take their 2007 acquisition of Harrah's Entertainment, now Caesars. Harrah's had a strong brand and loyal customer database, but was weighed down by bloated costs and unfocused management. Rule number 1. Spot neglected strengths. List 3 assets your target owns: brand, technology, real estate, royalties, and ask, why isn't this earning more for shareholders? If you can name 2 simple fixes, you found a candidate. Next, structure the deal with smart leverage. Private equity firms borrow big, sometimes 60 to 70% of the purchase price, to amplify their own equity. That sounds scary, but debt is just another tool if you manage risk. Apollo would negotiate long-term loans at reasonable rates, then use the company's cash flow to pay interest and principal. Rule number 2. Treat debt like rent, not a bet. Before you sign, project monthly interest payments against cash coming in. If your target can cover payments at 1.5 times cushion, you're in safe territory. No cushion, no deal. Once you own the company, fix operations fast. Apollo set up value creation teams to dive into every expense line: procurement, staffing, marketing, and drive out waste. In Harrah's case, they consolidated data centers, renegotiated vendor contracts, and replaced regional managers with operators who'd hit quotas. Rule number 3. Hunt your top 3 cost leak sources. Within 30 days of closing, list the 5 biggest expense categories. Pick the top 3, maybe supply chain inefficiencies, redundant IT licenses, or high-cost labor contracts, and renegotiate or reassign responsibility. But private equity isn't just about cutting costs. It's about building revenue engines. Apollo often poured capital into proven growth levers, loyalty programs, digital marketing, and strategic acquisitions. For Harrah's, they reimagined the Players Club, shifting from paper vouchers to targeted mobile offers. That bump and repeat visits drove a 10% lift in quarterly revenue. Rule number 4, reinforce one growth dial. Identify the single fastest payback investment, maybe a CRM system, website overhaul, or new sales hire. Run a pilot, measure lift, then roll it out company-wide. Let's pause for a quick mini case study. In 2018, Apollo bought a mid-sized packaging firm struggling to compete on price. They discovered the plant's maintenance backlog was causing 15% unscheduled downtime. Within months, they overhauled preventive maintenance, reducing downtime to 5% and freeing up capacity. By year 2, EBITDA, that's earnings before interest, taxes, depreciation, and amortization, jumped 40%, giving Apollo a fat profit when they exited. You're probably thinking, great, but how do I get my first deal? Start with small ticket roll-ups. Buy 2 or 3 businesses in the same niche. Pool their overhead, standardize processes, and create scale. Apollo's early success included combining family-owned retail outlets into a regional leader. That initial blueprint then used the same 4 rules but on a larger stage. Now, don't underestimate exit planning. Every private equity pro knows the deal ends when you sell. Apollo set target multiples, say 8 times EBITDA, and worked backward. They timed exits when market conditions were strong, often selling to strategic buyers who'd pay a premium for your turnkey improvements. Bonus tip, map your exit on day 1. Before you sign, list 3 potential buyers, competitors, PE firms, or strategic acquirers. Think through the story you'll tell them. We quadrupled recurring revenue. If your story resonates, you'll hit your price. Finally, remember the secret sauce, relentless accountability. Apollo held monthly value ops meetings with management, tracking 10 KPIs, margin, leverage ratio, free cash flow, customer retention, you name it. Anyone slipping got a plan or got replaced. That may sound ruthless, but here's the takeaway. You don't need a fancy office in Manhattan. You need a disciplined process. Rule number 1, spot hidden value. Rule number 2, structure debt sensibly. Rule number 3, slash top cost leaks. Rule number 4, amplify one growth lever. Follow that playbook and you'll think and act like Leon Black, turning underperformers into home runs. That's the private equity revolution simplified for you. Chapter 6, Quantitative Finance and the Algorithmic Edge. You've heard the buzz about quants and algorithmic trading, but what does it really mean for you? Imagine turning everyday math into money-making rules that run on autopilot. In this chapter, we'll strip away the jargon and break it down into clear steps you can follow, even if you've never coded a line. It all starts with a simple idea. Markets move in patterns. Your job is to spot one pattern, turn it into a rule, and test it. Take the moving average crossover, a classic quant strategy. Rule number 1, choose 2 time frames, say 50 days and 200 days. When the short-term average crosses above the long-term, you buy. When it drops below, you sell. That's it. No mystical insights, just clear if this, then that logic. Tip 1, keep your universe small. Rather than chasing hundreds of tickers, start with 5 stocks you know, maybe big banks or tech giants. Download their daily prices. Many free APIs exist. Run your moving average rule on each one. Track performance, percent return, max drawdown, biggest peak to trough loss, and win rate. If one stock consistently loses money, drop it and add another. Focus and iteration beat random diversification. But real quants don't stop at one rule. They build dozens of mini models and combine them. That's diversification at the rule level. Tip 2, mix your strategies. Alongside moving averages, add a momentum rule. Buy when a stock's 6-month return ranks in the top 20% of your 5-stock list. Then average the signals. If 3 out of 5 rules say buy, you buy. This smooths out the wild swings of any single rule. Let's borrow a page from Renaissance Technologies, the legendary quant fund. Jim Simons famously hired mathematicians and physicists who'd never traded a share. They focus on data quality above all else. Tip 3. Treat your data like gold. Before backtesting, clean it. Remove bad ticks, adjust for splits and dividends, and fill missing days with the last known price. Dirty data creates phantom wins or losses that vanish in live trading. Next comes backtesting. Here's where many novices trip up with curve fitting, tweaking rules until they only work in the past. Tip 4. Use walk-forward testing. Split your history into segments, say 2 years for training and 1 year for testing. Develop your rule on the first 2 years, then test it on the next year without any changes. Roll forward through your entire dataset. If your rule holds up consistently, it's more likely to survive future markets. Let's look at a mini case study. Sarah, a rookie quant, built a rule that bought biotech stocks after they rose 10% in a week. On paper, it looked stellar, 25% annualized returns over 10 years. But when she tested it out of sample, it collapsed. She realized biotech had 2 boom-bust cycles in her data, and her rule only captured the booms. She tweaked her rule to require a minimum market cap filter and only trade when volume was above average. After walk-forward testing, her adjusted rule returned a steady 12% with control drawdowns. By cleaning data and imposing realistic filters, she turned a broken strategy into a durable one. Of course, execution matters. Tip 5. Account for slippage and fees. In backtests, assume you lose 0.1% per trade to the bid-ask spread and another 0.1% in commissions. If your strategy needs 10 trades a month, that's a 2% annual headwind. If you ignore these costs, your profitable backtest will disappoint in live trading. Finally, risk management. Quants aren't gamblers. They control position sizes with precision. Tip 6. Cap your bets. Never risk more than 1% of your total capital on a single rule. If your strategy signals a position that would exceed this cap, scale it down. This way, a string of losses won't wipe you out. Putting it all together, here's your actionable checklist. Select 5 to 10 familiar stocks. Define 3 to 5 simple rules: moving averages, momentum, mean reversion. Clean your historical data for splits, dividends, and errors. Backtest with walk-forward testing, avoiding curve fitting. Include realistic slippage and fees in your results. Diversify rules by averaging signals. Cap position size at 1% per trade. By following these steps, you build a miniature quant shop on your own desktop. No PhD required. Remember, the strength of algorithmic trading lies not in complexity, but in disciplined, repeatable processes. You're not predicting the future. You're responding to concrete rules with consistency and cold logic. That's the algorithmic edge. Chapter 7. Fintech Disruptors and the New Guard. Let's be real. Traditional finance wasn't built with you in mind. For most of the last century, banking and investing were gatekept by a few elite firms, mostly run by people who looked the same, thought the same, and came from the same Ivy League schools. But in the last 2 decades, a new breed of disruptors has quietly rewritten the playbook. They didn't ask for permission. They built platforms, launched apps, and rewired finance for the smartphone generation. One of the sharpest minds behind this wave, a quiet, awkward, hoodie-wearing coder named David Klein, founder of Stash Wallet, now one of the most trusted mobile investing apps in the US. David wasn't trying to impress Wall Street. He just hated how confusing investing was. The fees, the jargon, the minimums. It felt like a game rigged for insiders. So he built something different, something your teenage cousin could use. And that's exactly what happened. Today, Stash Wallet has over 15 million users, most of them under 35. But here's the kicker. Most of them started with less than $20. Let's break that down. That's not just convenience. That's psychological design. Every button, every feature in that app is made to reduce friction and eliminate excuses. That's what fintech gets right. It designs for action. So here's your first actionable rule. Make your entry point stupidly simple. Don't worry about mastering ETFs or memorizing ticker symbols. Open an app like Stash Wallet, Public, or SoFi. Pick one. Set it to invest $5 a week in a low-cost index fund. That's it. Automation beats intention every time. The second big disruption? Peer-to-peer lending. Before, if you wanted to borrow money, you went to a bank. You waited. You begged. And if your credit wasn't spotless, you were toast. Then came guys like Ronan Chauvel, founder of LendMe. He looked at how eBay lets strangers trust each other and asked, why can't lending work the same way? Today, with platforms like LendMe, people lend directly to each other. No bank middleman. It's faster. It's cheaper. And if you've got solid repayment history, you can access funds without being bled dry by interest. Actionable rule number 2. If banks say no, don't stop there. Look into peer-to-peer lending or small business microloan platforms. Sites like Kiva, Upstart, and LendMe have funded everything from food trucks to freelance designers. But what about people looking to build real wealth, not just survive? Here's where crypto enters the conversation. And before you roll your eyes, no, we're not talking about chasing the next meme coin. That's gambling. We're talking infrastructure. Meet Maxine Feldstein. She co-founded LayerPay, a blockchain-based payment startup that helped small businesses accept digital payments without the insane fees of Visa or MasterCard. In the first year alone, she onboarded over 40,000 merchants, many in immigrant and minority communities who couldn't even qualify for standard payment processors. Her big insight: crypto wasn't about speculation. It was about ownership, control, and speed. That's her third rule. Follow the use case, not the hype. If you're curious about crypto, don't start with trading. Start by using it. Send $10 of USDC to a friend using a wallet like Phantom or Coinbase. Try buying a coffee at a shop that accepts crypto. You'll learn faster with $10 in the game than 10 hours of YouTube. Now let's talk pain points. Fees, delays, feeling overwhelmed. Traditional finance thrives on complexity. Confuse you, charge you. That's the cycle. Fintech disruptors kill that model by stripping things down to the essentials. Take Stripe. Jewish brothers Patrick and John Collison didn't just build a payment system. They made it invisible. You click buy, Stripe moves the money. No extra clicks. No friction. That's what modern finance should feel like. Fast, clean, boring. Your fourth rule? Chase simplicity. Reward clarity. If an app makes you feel dumb, delete it. If it takes more than 5 minutes to set up, it's not designed for you. It's designed to impress a venture capitalist. And finally, let's get honest. Fintech is not a silver bullet. It won't fix your spending habits. It won't protect you from bad decisions. But it will give you tools, faster, cheaper, smarter ones, if you're willing to use them. So here's the final rule. Start small. But start now. Buy one share. Set one recurring transfer. Try one new platform this week. Because the truth is, Jewish fintech leaders didn't wait for permission. They saw the system, understood its cracks, and built better ones. And today, their tools are in your pocket, waiting. You don't have to be rich to get started, but you do have to start.